The United States startup ecosystem experienced a significant surge in funding, rising by 75.6% in the first half of 2025, driven primarily by the booming artificial intelligence (AI) sector, according to a PitchBook report. Total investments reached $162.8 billion, marking the strongest performance since the peak of venture capital activity in 2021. This resurgence is largely attributed to substantial AI investments, fueled by major tech companies following the launch of ChatGPT in late 2022. Notable deals included OpenAI's $40 billion funding round and Meta's $14.3 billion stake in Scale AI. AI investments accounted for over 64% of the total deal value, highlighting investor confidence in the sector's potential. Conversely, U.S. venture capital fundraising faced challenges, with only $26.6 billion raised, a 33.7% decline compared to the previous year. This trend reflects limited partners' concerns about the asset class due to recent underperformance and liquidity issues. However, there is optimism for a recovery in exit activity, with IPOs and mergers and acquisitions (M&A) up by 40% year-over-year, supported by a more favorable antitrust environment and a recovering IPO market. Sectors such as AI, national security, and fintech, aligning with President Donald Trump's priorities, dominated IPO interest. The market's positive reception of IPOs from companies like Hinge Health and CoreWeave suggests a potential turnaround in venture capital dynamics.
Meta Platforms is making a significant strategic push into artificial intelligence (AI) development, with plans to invest hundreds of billions of dollars in constructing several large-scale AI data centers. Notable projects include the 1 gigawatt Prometheus supercluster set to be operational by 2026 and the larger Hyperion, which is expected to scale up to 5 gigawatts by 2030. These ambitious endeavors underscore Meta's commitment to leveraging AI for future revenue growth, particularly through AI-powered advertising innovations. The company has reorganized its AI efforts under a new division, Superintelligence Labs, and is actively recruiting top talent to lead these initiatives. Bank of America securities analyst Justin Post has maintained a buy rating on Meta, raising the price target from $765 to $775. Citing these developments as indicative of Meta's robust revenue trajectory. He projects third-quarter revenues of $47 billion, surpassing the consensus of $46 billion, and anticipates that Meta's AI investments will be a focal point in upcoming earnings calls. Despite a slight decrease in 2026 EPS estimates due to higher AI-related expenses, Meta remains Post's top online advertising stock for 2025, well-positioned to capture AI-driven advertising market share gains. CEO Mark Zuckerberg has reassured investors that Meta's strong advertising revenue, which reached nearly $165 billion last year, will support these projects. The company's stock has responded positively, with a 1% rise following the announcement and a 20% increase year-to-date. Analysts, including D.A. Davidson's Gil Luria, acknowledge that while Meta's AI investments have already bolstered its ad business, the long-term goal is to develop a leading AI model. This strategic investment underscores Meta's commitment to maintaining its competitive edge in AI, with potential implications for future revenue streams from AI-driven products such as the Meta AI app and smart glasses.
U.S. Commerce Secretary Howard Lutnick outlined the nation's strategic trade policies in a recent CNBC interview, focusing on trade relations with China, steel tariffs, and a new trade agreement with Indonesia. The U.S. is implementing a strategy of selling its fourth-best chip technology to China to maintain technological superiority and ensure Chinese dependence on American technology. This tactic is part of a broader effort to secure a competitive edge in the global race for technological dominance, particularly in the field of artificial intelligence standards. Regarding steel imports, Lutnick addressed allegations that South Korea, China, and Japan are dumping finished steel products in the U.S. market. To protect domestic manufacturers, the U.S. has imposed tariffs on these finished goods, while raw steel remains untaxed. Additionally, a new trade agreement with Indonesia aims to boost U.S. exports by allowing tariff-free entry of American goods into Indonesia, while Indonesian imports face tariffs. These policy initiatives reflect a concerted effort by the U.S. to strengthen its economic interests and maintain a competitive position in critical global markets, potentially influencing market dynamics and trade relationships across involved sectors.
Apple has announced a $500 million investment in a deal with U.S.-based MP Materials to secure a supply of rare earth magnets, crucial for the production of its iPhones and other devices. This move is part of a broader $500 billion commitment by Apple to expand its U.S. operations, aligning with the Trump administration's push to onshore technology manufacturing and reduce dependency on China. Rare earth elements, essential for various high-tech devices, have been a focal point in U.S.-China trade discussions due to China's dominance in processing these materials. The partnership not only aims to bolster Apple's supply chain, but also includes plans for a new recycling line in California to incorporate recycled rare earths into Apple products. This strategic investment by Apple is significant as it seeks to mitigate risks associated with global supply chain disruptions and potential tariffs threatened by the Trump administration. By sourcing materials domestically, Apple aims to strengthen its position amidst geopolitical tensions while advancing its environmental goals of using more recycled content. The collaboration with MP Materials also involves establishing magnet manufacturing lines in Fort Worth, Texas, expected to commence shipments by 2027 and support the production of hundreds of millions of Apple devices. This initiative is anticipated to create new jobs and develop a skilled workforce in the U.S., addressing part of the labor expertise gap critical for high-tech manufacturing.
Tesla has officially entered the Indian market, launching its first store in Mumbai and offering the Model Y for sale. This move comes after prolonged negotiations and attempts by CEO Elon Musk to secure lower import tariffs, which remain high at 70% for electric vehicles, EVs, and an additional 30% luxury tax. Consequently, the Model Y's starting price in India is approximately $69,800, significantly higher than its U.S. price of $44,990, positioning it firmly in the luxury segment. Despite the steep pricing, Tesla's entry into India, the world's third-largest auto market, marks a significant milestone, although it targets a niche demographic rather than the mass market. The strategic decision to sell in India reflects Tesla's broader ambitions to expand its global footprint amidst fluctuating sales in existing markets. While India recently introduced an EV policy that could reduce duties for companies establishing local supply chains, Tesla has not committed to building manufacturing plants locally. Instead, it continues to produce vehicles in China for the Asian market. This strategy suggests Tesla's cautious approach to tapping into India's potential, balancing current production capacities while exploring future opportunities for a more affordable EV offering that could appeal to the wider Indian market.
Anthropic has unveiled Claude for Financial Services, a specialized AI platform designed to enhance data-driven decision-making within financial institutions. This enterprise-only solution integrates with major data providers like Snowflake, S&P Global, and Morningstar, allowing users to access verified data directly from the source. The platform aims to minimize AI-generated inaccuracies, known as hallucinations, by providing audit trails and verified source data. Key adopters of this technology include Bridgewater and the Norwegian Sovereign Wealth Fund, highlighting its appeal to high-trust financial entities. The platform offers extended context windows, Claude Code for custom modeling, and comprehensive training, positioning it as a robust tool for research, investment reporting, and compliance automation. The launch of Claude for Financial Services marks Anthropic's first industry-specific AI solution, targeting analysts, portfolio managers, and underwriters. The platform is designed to address the rigorous demands of the financial sector, enabling complex analyses like Monte Carlo simulations and risk modeling. Despite the AI industry's ongoing challenges with hallucinations, Anthropic emphasizes that their integration with trusted data sources helps validate critical financial data. This move comes as financial services firms increasingly seek AI solutions to gain speed advantages amid market volatility, albeit with caution due to regulatory and accuracy concerns. Anthropic's solution is available on AWS Marketplace, with plans for Google Cloud Marketplace integration, reflecting the company's expanding reach in the AI landscape.
Wells Fargo is poised for growth following the Federal Reserve's removal of the asset cap, initially imposed in 2018, due to the bank's involvement in unauthorized account openings and other consumer abuses. The cap had restricted Wells Fargo from expanding its assets beyond 2017 levels until it met regulatory standards. Fed Governor Michael S. Barr acknowledged the bank's successful remediation efforts as the reason for lifting the cap. In a recent earnings call, CEO Charlie Scharf highlighted that while the removal of the cap provides new growth opportunities, any expansion would be strategic and gradual, focusing on enhancing returns rather than rapid expansion. Scharf emphasized that Wells Fargo remains committed to increasing revenue through strategic investments in its corporate investment bank, commercial bank, consumer business, and services for affluent clients, all funded by operational efficiencies. The bank is also advancing its digital capabilities, with a notable increase in digital account openings and a rise in active mobile users. Despite a slight softening in credit card spending growth, the overall financial health of Wells Fargo's customers remains robust, with strong debit card spending and improved consumer delinquencies. Looking forward, Scharf expressed cautious optimism about the economic environment, acknowledging potential risks but also opportunities for enhanced competitiveness and economic growth.
Kenvue, the parent company of well-known consumer brands such as Band-Aid and Tylenol, has announced the dismissal of its CEO, Thibaut Mongon, amidst increasing investor pressure for strategic changes. The company, which was spun off from Johnson & Johnson in 2023, is currently undergoing a strategic review to evaluate potential sales or divestitures. Kenvue has named Kirk Perry, a former Procter & Gamble executive and recent CEO of Circana, as the interim CEO. This leadership change is seen by analysts, such as Susan Anderson from Canaccord Genuity, as increasing the likelihood of a partial or complete sale of the company's assets. The market reacted to the news with Kenvue's stock price rising by approximately 2.25%, reflecting mixed investor sentiments. Some investors liquidated positions, while others were encouraged by the strategic review, a move many had advocated for. Notably, activist investors like Third Point and Tom's Capital have been influential, with Tom's Capital specifically advocating for a sale. The company has been focusing on improving profitability, especially in its underperforming skin health and beauty segment, which includes brands like Neutrogena and Aveeno. The strategic review is advised by Centerview Partners and McKinsey, indicating a serious approach to exploring potential divestitures or portfolio simplification. Kenvue's recent leadership changes, including the replacement of CFO Paul Ruh, underscore the company's commitment to addressing investor concerns and enhancing shareholder value.
Cyclacel Pharmaceuticals, Inc., CYCC, experienced a dramatic surge in its stock price on Tuesday, climbing 318.43% to $13.85. The stock's trading volume reached 21.9 million, significantly surpassing its average volume of 206.9K. Despite the lack of any immediate news to explain the spike, recent developments may have influenced investor sentiment. Cyclacel recently amended its exchange agreement with Fitters Diversified Berhad, and a study published in the journal Gut highlighted the potential of plogosertib, a pharmacologic inhibitor of PLK1 in treating fibrolamellar carcinoma, FLC, a rare liver cancer. The study's findings suggest that plogosertib effectively reduces FLC growth by targeting the DNAJ-PKAC fusion oncoprotein, which is crucial for the cancer's progression. This breakthrough could position Cyclacel's drug pipeline favorably in the oncology sector, driving investor interest. Additionally, Cyclacel's recent financial maneuvers, including 2 reverse stock splits and a private placement raising $3 million, have likely contributed to reshaping its capital structure, possibly enhancing its appeal to investors. These factors collectively may have fueled the stock's extraordinary performance, despite the absence of immediate news catalysts.
Deutsche Bank suggests that Bitcoin is entering a phase of reduced volatility and increased sustainability, as evidenced by its recent surge to a record high above $123,000. This milestone, achieved during the U.S. Crypto Week, marks a 75% increase since November, highlighting growing optimism around potential supportive legislation. Deutsche Bank analyst Marian Laber notes that this price rise is coupled with a historic decline in volatility, indicating a possible decoupling of Bitcoin's price movements from broader market instability. This trend is supported by increasing market adoption, regulatory clarity, and institutional participation, which are contributing to Bitcoin's stabilization. Despite a slight pullback to around $117,000, Labor emphasizes that Bitcoin's broader advance is driven by both macroeconomic factors, such as geopolitical uncertainties and de-dollarization trends, and microeconomic factors, like increased institutional adoption and technology advancements. While inherent volatility remains, these conditions suggest a maturation in Bitcoin's integration into investment portfolios, potentially signaling a shift towards a more sustainable growth pattern beyond short-term speculative phases. This development could have significant implications for market sentiment and the strategic approaches of investors considering Bitcoin as a viable asset class.